vol crush, which is kind of what I was expecting. We didn't really get a very significant move below 58.80, barely. We didn't really go above 50, 59.20. Things were a little bit more bearish to the downside, but none of that positioning was realized. We closed roughly right where I expected, up 16 points for the day. I'd projected 19, but yeah, not much of a significant change throughout the intraday trading. We will see realized vol crush because of that, and that was opportunistic, right? I mentioned last night in Pickles picks that realized vol had moved up a little bit over the IV. Or the IV had moved up a little bit over the realized vol, and there was an opportunity to short that profitably. And that's pretty much what we saw happen today. Over here on ES, fairly weak and choppy support at the 59.48 level was held today, despite some lower tests. We did end up closing above it, 59.63. 59.65's kind of a level of interest here. But much more importantly, 59.80, which we are still below. This kind of consolidation is not really bullish or bearish and could really break either way as we move into the holiday. Now, I do think with the NFP report Friday morning, I believe it's, what time is it coming out? NFP and unemployment are going to be at 8:30 a.m. before market open. After those are out, if there's not a big sticker shock on any of them, no big changes in unemployment, no ridiculously large moves in NFP, then I would expect that things will remain roughly as they are, except that event vol is going to price out a little bit. And that pricing out of event vol gives the bulls a big opportunity, especially if non-farm comes in line with the consensus estimate and jobs are down, unemployment is up, and volatility is falling off. That'll give an opportunity for a move up to the upside and more opportunity to short vol in our current range. So we'll probably see a lot more puts sold, and an attempt maybe to push up towards like 59.50 or so as we move into the OPEX week. And next week we have a lot of big data. We have inflation data, which is the very important second half of this labor data. If labor continues to be hot and inflation continues to be hot, then the Fed simply can't cut rates. And if the Fed can't cut rates, then yields need to be higher than they are. It's very simple, right? And so we'll be looking for that next week. We also have the Bank of Japan decision next week, which can have a very outsized effect and can, if Bank of Japan, if the Fed can't cut and Bank of Japan hikes, that's an effective leveraged rate cut from the Fed. And so, in terms of how leverage is in the system currently, that would present a great deal of risk, especially given that leverage on the carry itself is at all-time highs or near all-time, or not actually at all-time highs after today. I think it made even a new one. So that presents a great deal of risk into the middle of next week, and because of that, I would expect that the window of opportunity for bulls to recover some positioning or get out from under some of their short vol would be very narrow. Friday, Monday, Tuesday, maybe a little bit into Wednesday. Are they actually going to short vol before the BOJ decision? I mean, it's algorithmic too, right? So, they have stranded short vol positions to the upside of spot. Not a lot of them, but there are still some. And event vol is falling off, so yeah, they're going to short the event vol. That's that crush in event vol is
Bomber
usually
put
a
their
big
pickle in my jar
opportunity for
harger.
bulls.
Great
Thanks,
job
end of
today,
day
high
bomber.
end of day people.
Fitting name. Appreciate it. I think the Bank of Japan decision, maybe it's not next week. When is it? It's on the 23rd, so it's just following the OPEX. So yeah, even more opportunity to try to push things down into Tuesday's PPI. First, we get PPI, and then we'll get CPI following that on Wednesday. Next Thursday, we have retail sales, which is also a really big deal. Then we start moving into some housing stuff. Okay, so Bank of Japan decisions after the OPEX, but we still have inflation data at the beginning of next week. So Friday and Monday, really specifically, are the 2 days where they have an opportunity to crush out that vol and turn this around a little bit. When do you get Pickles picks tomorrow night? And you won't anyway. You want them? Did you see that consumer credit came in negative? It did. Which means people are buying less shit, which might act beneficially on inflation. How high up are the stranded positions? Really, I think around like 59.80 through 60.30 mostly. Anything above that's just pretty for right now. I'm not really concerned with that. But 59.80 to 60.30 I think could be a potential range for this to turn around and bounce into. We will see though. Obviously, Friday's data could have a big impact on that. We may not get any upside. I mean, if labor non-farm is hot or unemployment is down, especially because Michigan inflation expectations are likely to be higher, so Michigan's going to have probably no meaningful or positive impact on inflation expectations, which really leaves it up to the employment. And if employment continues to confirm that the labor market is strong and non-farms are continuing to move up, which they frequently do, then it's very likely that inflation expectations will remain anchored where they are until we get PPI and CPI data, both of which the swaps market are pricing in for much hotter prints. So the swaps market expect PPI and CPI to move up. They're usually not wrong. Oh, you're asking about my PP. Somewhere else, maybe a different day. Grim 2. Dollar up today, got a little bit of a lower high, rejected off of it, although the consolidation could still turn around and yields are still crazy elevated. The 20-year going above 5% earlier today. The 30-year auction kind of turned that around a little bit, but not surprisingly not very much. Commodities, a little less wonky today, but we do have precious metals and energy moving. Let me check Henry Hub. I don't know why I don't have that on my other list. Yeah, Henry Hub moved up another like 6% today. So we do have some moves in nat gas, which is stabilizing the drop that we're seeing in crude. Crude's still holding above 70 a barrel and above the inflationary level at like 72 a barrel. So that's still hot enough to be driving inflation higher. And we are seeing a little bit of precious metal interest. Copper up pretty bigly today. Not too much going on with agriculture or materials, it looks like. Correlation pretty flat. Didn't really come down, didn't really go up. We had some spikes earlier, but that kind of normalized and everything looks pretty flat day over day. But what we're not seeing is people driving back into the dispersion trade, trying to push or seeing that correlation push down either on the monthly or the weekly or the 3-month. And that's probably significant. And a little bit here we're going to look at the correlation between VIX and cash VIX, and that might tell us a little bit more. Carry leverage did hit a new all-time high today. However, it did close a little bit lower. But it looks like we're starting to float up to around 9.3x. And we're still not seeing any moves on the front end leverage, right? So we're seeing leverage on the top end skyrocket, but leverage on the short end isn't moving. And this is part of that cost to carry dynamic. So they're shorting the short end, otherwise the leverage would be rising, in order to pay the cost to carry on their infinitely expanding long end leverage. And that's a really dangerous position to be in, because if anything moves or they get squeezed on the short end, they can no longer afford their cost to carry and they have to mark to market their securities in order to cover the margin call. And they're doing that at 9.3x leverage, which means their losses would compound really, really, really fast. And we'll start to see over the next week if they begin to risk any of this off. Going into the BOJ decision, it's super degenerate because the BOJ decision could collapse this like it did in August really rapidly. And so the risk there is insane. And I kind of mentioned after what had happened in August that things weren't really going to be the same, and they're not, right? They can't leverage up the short end anymore. And so there's a divergence in their margin risk in their portfolio, and it's keeps pushing apart more and more, and it can only diverge so much. It's there's a mechanical limit to that. And if anything were to happen, like the Fed were to raise rates, for instance, inflation moves up, and the Fed's like, oh, we gotta move rates up point 0.1, right? Because inflation's getting too hot. Everything would just blow up. Because the short end would immediately get squeezed, right? Or if any near term inflation expectations were to pick up too much, and they had to, like, we start seeing TIPS auctions come in a little higher, and those inflation protected securities pick up demand, we could see yields at the short end go down, right? And if the yields at the short end go down, then their short position on those will get so yeah, this still just carrying tons of risk. Forward yield on volatility positive into the end of the day, but again, just barely. They're doing a really good job keeping that pinned and keeping that bond portfolio interest from coming into long vol. Move is now back over 100, and that's a pretty significant level. Generally, bond volatility starts to get pretty crazy above 100, and we're seeing that continue to move up with the breakdown and dispersion in the underlying, which means that there could be continued risk off on the back of this. Skew moved up yesterday a tiny fraction, but I think that was mostly just that end of day put selling in order to stop us from dropping to 58.50, and they pushed us back up off of that like that Vana flip, and back towards like 59.15, where the market maker was a little bit more stable into close. I would say today this is probably going to be pretty flat, or maybe we see it continue up a little bit because there was a decent amount of put selling today. 29% of the S&P above its 30-day moving average at the end of the day yesterday, so probably another red flat day for that to really start falling off again, because remember, it's just tracking the moving average. And this is the thing that I was talking about before that we wanted to look for, is we're now seeing a slight increase in correlation between VX and cash VIX. And I said, what we'd be looking for is a couple days of this starting to turn around as their ability to short vol in this environment starts to break down, and correlation between the 30-day VIX and the VIX end of quarter VIX start to pick up. And as those become more correlated, the demand for volatility, long volatility, will rise, which pushes the short position out really rapidly. So generally, when you see periods of vol shorting, especially deep periods of vol shorting, which this is one, as that vol shorting starts to break apart, the risk at the tails becomes greater, and the desire for long vol becomes greater as well. And as people pile into long vol and rapidly force out the short volatility positions, and so generally, the move down is really swift, and then as it breaks apart very slowly, it'll start to break apart more rapidly, and you get larger, longer, and sustained moves in VIX moving up, basically. And so, this is part of what's keeping our volatility environment kind of wonky right now. We're going really low, going back up, is they're trying to maintain a handle on that, and it's slipping, right? That's the first sign that it's slipping, is that correlation picking up. And so if we start to see that correlation rise to something that's statistically significant, like, above 70%, that would be a cause for concern. Fed fund futures didn't really move around much today. I don't think I give a shit about that. It's up about 9%, so we priced in 0.15 more rate cuts than we had before. It's kind of irrelevant. The 10 2-year spread is now at 40, which is higher than it was yesterday, and that keeps ending up being true day over day. And this is due to a bear steepener and is bearish. This is not a good sign, especially if it continues to rise. We're starting to get to very rapidly get to levels seen before the GFC .com bubble COVID crash. And the rate at which we're getting to those levels is frightening, especially given how long the curve was inverted prior to this. If you look at prior inversions, even in the 90s, it oscillated a lot, right? This has just been one solid inversion all the way through until now. Really until like August of this year, that really started to snap back, and I don't really know what this is going to look like, because it's really not. There's things that are not similar to the prior times that this has happened. Usually it uninverts, we hit a recession. Through that kind of like upper period, things flatten out, and then things start to normalize and get better, and then we start moving into our next financial crisis. So yeah, I mean, I would watch this really closely as it continues to push up, especially the speed at which it's pushing up. Very concerning. Lastly, on the technical side for the S&P, we have the EMA 30 actually starting to move under the 50. We've been trading under the 50 quite a bit lately, and that upside resistance on the 30 is moving down, which is, I think really since August, like the first time we've seen any significant downside moves in the EMA 30. And usually, that crossing under is kind of a bearish sign. We got a bounce back in August, but that crossover is usually not bullish. Not as important as like the 50 crossing the 200, which we're very, very far away from. But definitely something in the near term to be concerned about. It still looks like 5830's been solid support. We got a little bit of higher high here. And this just looks like it's kind of continuing to consolidate now. So if we do get some bullish price action going into the end of the week here, we might retest like the 6,000 level right around there before, finding more sellers and possibly moving back down. I would think that the post-OPEX period, or period going into the OPEX, would be the period most likely for us to see a loss of that 5830 level, if things are bearish when we get there. Are you rich? Well, yeah, I guess. Would you recommend getting into trading part-time, or should I focus on my current skill, programming? I mean, if you don't have a ton of time to dedicate to it, then, but it interests you, you could, kind of pick it up as a hobby until you feel more comfortable with it. I'll warn you now that you're probably, if you were to start now, you'd probably be about 2 to 3 years from realizing any kind of consistent profitability. So it's up to you, and doing it part-time, maybe 3 to 5 years. But I would recommend just messing around with paper trading, seeing if you can develop something. Read up on it. There's a lot of good books that I recommend. You can find those in the thread in the general chat on the Discord. Don't start gambling, but it's a long road, and so if you still have a lot of room to grow in your current career, your attention's maybe better focused there. But the call of the market it's a hell of a siren song, so I get it. Anyway, that's it for today. Thank you guys for tuning in. I will enjoy your holiday. A dead president morning period, whatever. And have a good one. I'll see you guys tomorrow night at 8 p.m. for the Quant Roundtable. Later.